How do oil futures contracts actually work? Imagine trying to lock in a price today for oil you might buy or sell months from now. That's exactly what trading oil futures contracts is all about. These contracts are agreements made today that specify a certain amount of crude oil to be bought or sold at a set price on a future date. They are traded on specialized markets called futures exchanges, like the New York Mercantile Exchange, which is part of the CME Group. The most common oil futures contract is for West Texas Intermediate crude oil, which is a major benchmark in the industry. Each of these contracts controls 1,000 barrels of oil. The price is quoted in US dollars per barrel. The minimum price change, called a tick, is $10. This means if the price of oil moves by 1 cent, the value of the contract changes by $10. Trading happens almost every day of the week, starting on Sunday evening and ending on Friday afternoon, with a short break each day. Contracts are usually for a specific month, and when that month arrives, the contract either results in the actual delivery of oil or is closed out before that happens. The delivery point for West Texas Intermediate oil is Cushing, Oklahoma. This location is key because it has large storage facilities and connects to many pipelines. Some contracts are settled by physically delivering the oil, but most traders and investors close their positions before the delivery date to avoid actually taking possession of the oil. This is especially common among speculators who want to profit from price changes without dealing with physical barrels. Companies in the energy sector use these contracts to protect themselves from falling prices. For example, an oil producer can sell futures to lock in a price for their future output. This way, they know what revenue to expect regardless of market swings. Airlines, on the other hand, might buy futures to shield themselves from rising fuel costs. Traders and investors buy and sell these contracts to make money from price movements. If they think prices will go up, they buy. If they believe prices will fall, they sell. Futures markets also help discover the current market price for oil based on supply and demand expectations. These prices reflected what traders collectively think will happen to oil prices in the future. For investors, oil futures are a way to get exposure to the energy market without owning physical oil. Because futures contracts are highly liquid and serve as a global benchmark, they are popular among traders looking to maximize their investment. Plus, the leverage involved allows traders to control large amounts of oil with a relatively small amount of capital, which can boost potential gains but also increases risk.